silver-filled pastes, silver-bearing solders, silver plating on contacts, tiny amounts per part. But at global scale, it turns into a demand block that never shows up on a casual chart watcher's radar until it's too late. And right as COMEX is bleeding registered ounces, the semiconductor supply chain is flashing red again. Big manufacturers have taken ugly profit hits in memory. Major U.S. fab projects have slid and subsidy expectations got trimmed. The public story is always market conditions, components, timing. But the hidden story is simpler. You can pour billions into clean rooms and lithography tools and still choke on a missing material that costs almost nothing compared to the final product. If you can't get it, you can't ship anything. You can't AI your way around a metal. So when you see $80 silver and you think speculators, ask a better question. Why did buyers pay all-time highs and still remove tens of millions of ounces from the delivery pool? Because some of those buyers are not investors. They are operators, people whose factories stop if they can't source the right conductive inputs, and they do not get to wait for a dip when production schedules are on the line. This is where the paper story and the physical story split into two universes. In the paper universe, a futures contract is exposure. In the physical universe, silver arrives in 1,000-ounce bars, gets fabricated, and disappears inside components for a decade. COMEX is the bridge, and that bridge just got stress tested. Let's talk numbers without wasting your time. Electronics demand is enormous. One major industry estimate puts it around 465, 6 million ounces per year. That's not nice to have. That's embedded demand. If the metal isn't there, products don't ship. And that's why the early December drain matters. Registered inventory was roughly 113 million ounces in late November, and the December pull cut that pool hard. You're now staring at a delivery market that can feel like less than a season of coverage for certain industrial flows in a world that runs on just in time with almost no buffer. Now, a lot of people will say, relax, there's still eligible inventory. Here's what that actually means. Eligible is metal sitting in a COMEX-approved vault that meets specs, but it is not committed to delivery. It belongs to someone, and that someone can say no. Registered is metal tagged for delivery. When registered drops, the deliverable pipeline narrows. Now here's the chess move. A major vault holder shifted a large chunk of metal from registered into eligible right as the drain accelerated. Translation, metal that could have been demanded got put behind a not for delivery sign. In normal times, that's a footnote. In a tight market, it's a message. It says, we're not handing this over at these prices. And if a player with a giant stockpile chooses to reduce delivery availability during a rally, that doesn't scream top. It screams, the future price makes today look cheap. Zoom out. Why is supply so stubborn? Most silver doesn't come out of the ground because a company chose to mine silver. It comes out because someone mined copper, lead, or zinc. Silver is a byproduct. That means production does not surge just because silver goes from $25 to $80. The parent metal economics drive expansion. So supply is slow and rigid. Demand is fast and structural. Solar keeps climbing. Electronics keeps compounding. Vehicles keep adding circuitry. Grids keep upgrading. And AI is a demand multiplier that older forecasts didn't fully capture. So you get a market that can't flex supply and won't stop demanding metal. That's the setup. But the plot twist is where the metal is going. While Western traders argue about charts, Asia has been securing industrial metals like it's a national sport. Shanghai's silver inventories fell below roughly 446 metric tons in October 2025, the lowest in years, during a period of heavy manufacturing output. That's procurement behavior, not random fluctuation. China also dominates refining capacity, often estimated around 70% of global throughput. Mix that with purity standards, and you get a one-way door effect. Metal can leave Western availability, get upgraded, and become sticky inside a different ecosystem. It's not destroyed, it's locked. And locked metal might as well be gone if you're a manufacturer on a deadline. Now connect this to chips, because this is where it stops being a precious metal story and becomes a global technology story. Memory prices surged into late 2025, not gently, in spikes. Reports of DRAM jumping around 60% from September to December. Suppliers warning customers about costs doubling in a week, shipments slipping for weeks. That's not normal tightness. That's the supply chain bending. The public explanation is always capacity. But capacity isn't just buildings, it's inputs, materials, yield, reliability. And silver shows up in places the average person never sees. Conductive adhesives, contact plating, solder joints that must survive heat cycling, vibration, and microscopic tolerances. Could you replace silver everywhere? In some low-grade applications? Yes. In high reliability electronics? You can try, but you pay for it in failure rates, redesign cycles, and qualification delays. Companies don't substitute unless they're forced. which means when silver tightens, the first thing that changes isn't demand. The first thing that changes is price. And that's what you watched in 2025. A 158% move in a year doesn't happen because a few retail investors got excited. It happens when a market wakes up to a physical imbalance that's been growing quietly for years. You can see the stress in the plumbing when borrowing metal gets extreme. Late 2025 saw lease rates, what industry pays to borrow physical silver, spike to absurd levels in tight windows with reports of triple-digit annualized prints. That isn't sentiment, that's scarcity. This is also why the big stockpile holders matter. One major bank is widely believed to have accumulated hundreds of millions of ounces across the last decade. Numbers around 655 million ounces get cited. Whether that figure is perfect or not, the behavior is the tell. When a holder shifts metal out of deliverable status during a squeeze, they are voting with inventory. And now the deficit math. We've run multiple consecutive annual deficits. Demand has exceeded mine output plus recycling. That means we've been living off stockpiles, the buffer. Buffers don't last forever. 5 straight years of deficits can stack into hundreds of millions of ounces of cushion gone. Annual mining has hovered in the mid 800 million ounce range. Recycling adds something like 180 million in many years. And yet the gap persists. If your annual shortfall is on the order of 117 to 200 million ounces, the only fix is inventory. Until inventory is thin enough that price has to do the rationing. Here's the psychological trap. They show you a price chart and tell you the chart is reality. They'll say, if it's scarce, why isn't the price already higher? Then, when the price finally moves, they call it a bubble. That's how people get trained to be late. In real shortages, the physical stress comes first. Then the price snaps. Then the headlines arrive. COMEX draining in early December was the stress. $80 silver is the snap. The headlines are next. And the next milestone is not a chart pattern. It's a calendar. January 2026. And this is the part most viewers miss. Delivery stress doesn't show up first in price, it shows up in behavior. More contracts standing for delivery, more metal leaving registered. More quiet, scrambling in the background. If January opens and the minor month suddenly acts like a major month, you'll know the market is no longer trading silver. It's rationing silver. Historically, January isn't the biggest delivery month, but open interest going into January has been unusually heavy, and the curve has been flashing a classic warning sign: backwardation. Spot above futures. In plain English, pay extra to get it now. Backwardation isn't a cute technical term. It's what happens when real buyers care more about immediate physical access than about financing costs. It's what happens when the market starts doubting timelines. And if manufacturers doubt timelines, they don't wait. They hoard. They pull forward orders. They lock contracts. They shift from just in time to just in case. That single behavioral shift can drain inventories faster than any chart trader can imagine, because manufacturers buy in tonnage, not in tweets. Now think about what happens if delivery gets pressured while major players keep eligible inventory out of reach. You get a squeeze that isn't driven by leverage, it's driven by necessity. And that's why silver at $80 is not the end of the story. It's the moment the story becomes impossible to ignore, because when an industrial user needs silver, cash settlement is useless. You can't solder a board with dollars, you need atoms. If the delivery system can't source those atoms on schedule, the problem is bigger than price. It's credibility. The market solution is higher prices, because higher prices coax metal out of hiding. But higher prices create second-order effects. Electronics costs rise, server costs rise, vehicle electronics costs rise, grid hardware costs rise, consumer devices get more expensive, and once that cascades, this stops being a market debate and becomes a policy debate. Strategic materials don't stay hands-off forever when production is on the line. Now, some people keep repeating the comfort line, high prices will bring new supply. That's how commodities are supposed to work. But silver doesn't behave like a normal commodity, and 2025 proved it. Prices sprinted and mine supply didn't suddenly surge, because byproduct supply doesn't pivot on a dime. New primary projects don't appear overnight. Permits don't accelerate because headlines got loud. The geology doesn't care. So the only fast supply is inventory, and inventory is what just got attacked. So where does this go? If January delivery stress intensifies, the market has a small menu of outcomes. 1. Metal shows up from eligible because holders decide the price is high enough and release it. That requires a price that makes them happy. 2. Pressure builds toward more cash settlement or workarounds, which bruises trust and pushes more participants to secure metal elsewhere, tightening things further. 3. The price climbs until non-essential demand slows. Jewelry and silverware can cool. Some low-margin applications can redesign over time, but critical electronics demand doesn't vanish. It gets paid for. In other words, the price has to rise until the marginal ounce comes out of hiding. Now let's add the catalyst that could turn tight into violent. Advanced batteries. There is a development path in batteries that uses a silver-carbon composite layer to solve stability issues and improve performance. If that design scales, it can meaningfully increase silver use per vehicle, not milligrams. Real weight. To understand the scale, compare magnitudes. Today, an EV might carry something like 25 to 50 grams of silver across electronics. A future design that pulls silver into the core architecture can move the conversation toward hundreds of grams, even up to a kilogram per pack in some projections. 1 kilogram is about 32 troy ounces. Now do adoption math. If even 20% of global EV production moved in that direction, you're suddenly staring at a potential extra demand stream measured in the hundreds of millions of ounces per year. Numbers like 500 plus million ounces appear in scenarios like that. That's not a tailwind. That's a demand meteor hitting a market that's already short. And you don't need full adoption for the market to react. The moment buyers believe a big new demand stream is plausible, hoarding behavior accelerates, because nobody wants to wake up after the contracts are signed and the shelves are cleared. So the market reprices on probability. That's why the "it's just a bubble" narrative is so dangerous. It trains people to dismiss the early phase of a structural repricing as speculation. It makes them expect a repeat of old squeezes that were driven by leverage. But this engine is different. This is industrial drawdown plus rigid supply plus compounding demand. And if you want to understand what that ending looks like, stop thinking about silver like an ornament and start thinking about it like a critical input. When a critical input becomes scarce, price doesn't politely drift higher. It jumps, it gaps, it punishes complacency. And it creates panic buying, not from retail, but from procurement departments. Now here's the simplest perspective shift. COMEX registered inventory is not the world's silver. It's the world's readily deliverable Western silver at one specific venue. If that pool shrinks to a few months of coverage for industries that can't function without it, the system becomes brittle. One big buyer can move it. One stress month can expose it. That's why January matters. Because if January becomes the moment where demand for delivery outruns what registered can provide, it forces a repricing of what real metal is worth compared to paper metal. That repricing doesn't have to be permanent to change behavior. It just has to happen once. Once the market experiences the possibility that paper claims can't be satisfied smoothly, trust changes. Buyers start securing. And when trust breaks in a commodity market, it doesn't heal quickly. It heals when inventories rebuild. And inventories rebuild only when supply exceeds demand, which is not the world we're in right now. So if you've been wondering why silver can sprint while vaults are being drained, here's the answer. This isn't a chart story, it's a coverage story. How many days of physical metal remain for the industries that can't function without it? How fast is that coverage shrinking? And how quickly do big players move once they see the clock? Now I want your take. Do you think COMEX can smoothly deliver through January 2026 without a credibility shock? Or do you think we're about to see a forced repricing of real metal versus paper metal? Drop your answer in the comments. And if you want the next update the moment new vault numbers hit, tap subscribe. Short, simple, and you'll be ahead of the headlines. Now let's close with the logic that the system keeps trying to blur. Silver is constrained by a supply chain that doesn't respond quickly, and by demand, that is becoming more technologically essential every year. When demand is optional, the buyer walks away. When demand is essential, the buyer bids. Electronics is essential. That's why memory prices spike. That's why chip delivery schedules slip. That's why fabs can be delayed despite billions spent. Because the whole system is a machine, and silver is one of the tiny gears that makes the machine turn. Remove that gear, and the machine stops. So the market is doing what markets do when reality finally outruns the story. It's repricing. The question isn't whether silver should be $80. The question is, what price forces enough metal out of hiding to keep the global electronics engine running without interruption? And that number is not set by opinion. It's set by logistics and inventory math. COMEX just showed you the math is tightening. January will show you how tight it really is. And when the world realizes available was an assumption, not a guarantee, the scramble won't be slow. It will be immediate. Because the moment a manufacturer misses a shipment of critical components, they don't call a trader. They call procurement. And procurement does one thing. They secure supply at any price, because the cost of stopping production is effectively infinite compared to the cost of paying up. That's the engine behind the next phase. We're not at the end of the silver move. We're at the moment the industrial world starts treating silver like what it is, a strategic metal hiding in plain sight. Keep your eyes on the vaults, keep your eyes on the curve, and watch what happens when the calendar flips to January.